Hey there, fellow entrepreneurs. Do you find yourself facing the psychological toll of business ownership? We get it. The struggle is real. Do any of these sound familiar? Anxiety, unexpected challenges, strained relationships, and that relentless to-do list that just won't quit. But fear not, because EntreThrive is here to rescue you. EntreThrive understands the struggles of entrepreneurship and is ready to guide you through transforming your life, gain confidence in decision-making, find balance, and rediscover your purpose. Say goodbye to stress, burnout, and hello to a life where you personally and professionally thrive. Visit EntreThrive.com today. That's E-N-T-R-E, thrive.com today, and start your journey to holistic well-being. And here's something special for our listeners. Download a free EntreThrive EntreClarity Guide, a powerful tool designed to help entrepreneurs discover their guiding truths, personal principles, and beliefs that guide your decisions and actions. Head to EntreThrive.com now to get your free guide. That's EntreThrive, because your success starts with a healthy mind.
Here's what's next on the Nice Guys on Business.
Okay, so maybe it's not reasonable for you to organically get to 2 million of EBITDA yourself, but would it be feasible for you to find other similar businesses to maybe combine your economics in some way so that the aggregate, if you guys, kind of figure out a way to work together, to kind of aggregate the businesses, could you present, those kind of economics, that 2 million and above in EBITDA as a combined entity? Everybody's still running their business, but you've essentially gone private equity, pre-private equity, right? Mm-hmm. Like you haven't taken their bite, right? But you've essentially configured yourself by doing kind of that roll up or add on or tuck in strategy already.
In The Art of War, Sun Tzu wrote, "Keep your friends close, and the nice guys on business closer." Go from where you are now to where you could be. Get expert tips to grow your business, to be more productive and more efficient, whether you're trying to build influence, grow your community, or make it rain. Best-selling author of Nice Guys Finish First, Doug Sandler, can lead the way. The Nice Guys on Business is produced by Turnkey Podcast Productions. Now, here's your host, Doug Sandler.
So, Nice Guy community, I was listening to about 6 other podcast hosts introduce today's guests, and by the time they were done, as I just explained to him before I hit the record button, they had run out of interview time. The only way I can shorten today's guest bio is to say this. He's got 30 plus years of experience, which equates to wisdom. Kirk Michie, he's 10,000 plus hours of experience to make him an expert in the capital raising and M&A space with over 1 billion with a B in M&A processes. I'm here to talk to him today about some of the musts as it relates to selling your company, avoiding some of the predators that may be out there. Break it into simple, understandable points for you, because I know if you're like me, your third grade curiosity might get the best of you. Sometimes you're just trying to figure out what to do with your business that you have grown. We're going to talk to Kirk. He's in the guest seat today. Welcome to the Nice Guys on Business, Kirk.
Thanks, Doug. Appreciate it. I wish I could do my bio that quick.
See, I see nothing about your bio. And I'm not saying that. You know what? Anybody that wants to know more about you, just you guys, Nice Guy community, we've been doing this 1,500 episodes. There's a link in the show notes to get exactly that. You can read it. And he's got, I'm telling you, 10,000 plus hours. I think that anybody would consider him an expert in the world of finance. You've done all of the stuff as it relates to money. How is it that you landed in the M&A space? Was it because you enjoyed the transaction? Did you enjoy the new relationships? What is it about M&A that you like so much?
So that's a fantastic question, because so first of all, I have a lot of useful scar tissue that leads to me being in this spot. So some of it is I'm a baby boomer, and boomers have been an entrepreneurial generation. And so what's happened is that I started out my career as a client-facing financial advisor. And many of the clients that I was working with were building businesses. And one of the things that was fascinating to me as an investment advisor was that the place to make a lot of money seemed to be in alternative investments and not traditional investments. And that either meant hedge funds, which to my mind is just a cool pricing scheme to take more of the client's money for doing the same kind of mediocre performance, or private equity. And within private equity, you could kind of go earlier stage and say venture capital, or you could later stage and say, kind of public to private buyouts. But that was interesting to me. And I beat my head against the wall trying to get into the business because the entire private equity community was essentially saying, hey, you're a retail financial advisor and we're all,
Right.
kind of what we are. Right. And so what happened, though, was that at a certain point, I get a call from a former colleague who says there's a private equity firm in Los Angeles looking for a guy with your skill set. And at the time, I was trying to build what's called a turnkey asset management platform. And we were running out of investor money. So I returned this guy's call. He says, look, we need a Dr. Doolittle. We need somebody who knows how to talk to the investors. Because we don't know how to talk to investors. We know how to put together deals, but we don't know how to raise money.
Right.
And we don't know how to talk to investors. And so in short order, I became the partner in charge of capital raising and investor relations for a buyout firm. And then what happened for me was that 7 years into that, we'd done 14 deals and I was going through a divorce. And I could no longer be on the road 80% of my time and keep half custody of my kids.
Mm-hmm.
So I went to my partners and I said, look, I can't do this anymore. And I was the public face and voice of the firm. And so we worked it out so that over a period of about a year and a half, I left, kept some of my investments, but lost most of them. Kids were worth a lot more to me than that. And I went back to being a financial advisor focused on M&A. And, what happened for me 3.5 years ago is that I no longer, felt like the highest form of my skill set was in being a financial advisor. So I started a boutique advisory firm and it caught fire. I mean, our founding month was the first month of lockdown in California for COVID. So it should have not been a great time to start. But my entire network just sort of said, oh, that's what you do. And we went from, one client to 7 clients, on a monthly consulting fee. In 6 months, we had within a year of our founding done a $215 million sale of a private company to a public company.
Love it.
In the 2 years since, we've done $1 billion worth of transactions. And,
incredible.
Yeah.
All right. So take me here for just a second, because there's a lot of people in your space, but a lot of them are, the legal, they're the attorneys that are in there. They understand contracts and all of that. And I know in listening to you on several other episodes that you did, I don't want to attorney bash because I have a lot of them as clients, but at the same time, I want you to share a little bit about what that unique value proposition is that you offer the market, as opposed to, hey, just go into an M&A attorney who knows all of this stuff. So maybe just help me with that a little.
Yeah, so I would tell you that the distinction between what an investment banker does and what an M&A attorney does in a transaction, the investment banker creates a competitive tension to drive higher price, better terms, more legacy control. So said simply, I'm the guy who helps you get a lot of money for your business. The attorney's focus is on making sure that you get to keep it after the transaction closes. Right. And so an attorney probably wouldn't be able to create the competitive tension with multiple buyers to drive a deal. And even if they did, their hourly rate would start to go up. And so your kind of aligned incentives become misaligned that way. Mm. So, I would say, though, that most of the differentiation that has helped me in my firm is the advisory skill set, because most investment bankers are transactional animals. And, it's not, I'm not criticizing other investment bankers. It's just that they're not relationship people. They don't build things over a long period of time because you're in close with them for some period of time. And as soon as the transaction closes and the closing dinner, which they pay for, is over, you handshake or hug and then, kind of have a nice life. And unless you've started another company that they're going to sell down the road, it's probably the last time you ever see them.
It's interesting. I wrote a book called Nice Guys Finish First, and the subtitle of it was Winning Business Through Winning Relationships. And it really is, you could take the same skill set that you have accumulated and grown in your M&A world and apply it to almost any other business and be successful at it because of those relationships. So maybe before we head on to some other questions, talk to me about the relationship aspect of what you do and how you do it.
Yeah. So the most common question to ask an investment banker is, do you specialize in a sector or a specific size of deal? And what I say is, I specialize in connection with founders. I will only work with selling founders, not hired CEOs, not people that are detached from kind of the founder and their why. And it is all about the covenant we can develop together, right? Like if it's a collaborative transaction. So if you do your things, I will get you to here, but we're going to work on it together. I'm not working for you. You're not working for me. We're not dictating to each other. But if we can collaborate, if there's chemistry, then we will get to a great outcome. It doesn't matter what the subject matter expertise necessary is.
Right.
And that's what we work on. Now, there's certain practical realities in that because we have a lot of inbound demand, we have monthly retainers or consulting fees that price us out of the market for some people. The percentage of the transaction that we take on certain kinds of transaction might make it not worthwhile depending on the kind of transaction. So we talk a lot to the founders about their options. And that's also why we built the Candor Advisors National Network. We've got 22 other investment banks that we refer deals to. But if we're not the right one, we want to make sure that we're not just telling the founder, hey, listen, we're too expensive or we're too upmarket. Good luck to you. We still want to get them to the right outcome. So we've developed a network for them.
Talk to the person or the business owner or the founder specifically in our community, because we know we deal with a lot of founders in our community. It's not a lot of C-level folks, not a lot of CEOs that were hired to go to work for an organization, but the people that bootstrap their way into this organization, and they tend to be the ones that are most emotionally connected to their business. Talk to those people that are out there. How do you know when you have a business that is worthy of selling? I mean, it's not just the attitude of the founder that says, "Hey, I got to come up with an exit strategy." There's got to be a certain formula of something that they have grown or certain advice that you can provide them. So, who in our community is like an ideal fit for selling their organization?
Yeah. So this is a fantastic question because the answer to it is so simple, and that is that. So every financial buyer out there, and that would mostly be private equity firms, but they're driving, because they have around $1 trillion worth of what we refer to as dry powder, committed but uninvested capital.
Right.
They're driving the market. And so they make strategics pay up for business, or they buy the businesses themselves. They get into competition with each other. Every inbound email or phone call we get from a private equity firm would sound like they're all looking for the exact same business. 2 million to X million of EBITDA, in other words, transferable economics, recurring revenue, low CapEx, and no cyclicality, right? Well, Who wouldn't want to buy a bunch of those? Those sound like 15 to 20% yield bonds with no risk in them. I mean, who wouldn't want to buy those, right?
Okay, but hold on before you continue. If you have, and I'm going to use my business as a typical example, we're not at $2 million a year. We're significantly less than that, but we know we have all of the other parameters that are involved. So I'm going to put myself into the equation for a moment because I'm going to get free coaching from you because you're here and it doesn't cost me any money to have you here. As a matter of fact, I think you're sponsoring one of the episodes, so you're even paying to be here. So I've done this right. We have all of the things, not cyclical, recurring revenue, contracts with our clients, all of the things that you would think that a company would need to have to be saleable, but not yet scalable. So we are scalable, but we are not yet there. So how do you advise somebody that is in these early stages? And we've had this business for almost 7 or 8 years now. So we know we're established. We're past that. We're going to go out of business tomorrow because we can't pay our bills. There was a time when we were paying our staff before we were even, that we were paying them. We weren't even paying us. And finally it has reversed. So talk to those people in our community that there's probably more of them than your $2 to $10 million people in our organization, in our listening audience.
Absolutely. There's a lot more of them, period. That's the bulk of small businesses, right? And I think, by the way, you just came up with your new adjunct podcast.
What is
Scalable, but not saleable. I think I like that.
Okay.
So, what all of this private equity money and all of these different forms of private equity firms, whether they call themselves search funds or independent sponsors or private equity funds or buyout funds or, growth capital businesses or, mezzanine finance, like all of those different sources of private capital chasing the same deals means, by definition, that if they find a platform investment, that $2 to $10 million business in your sector, let's say they're looking to roll up podcasting producers, right? then they've got to start doing tuck-in or add-on transactions. And every one of the businesses that is professionalized enough and clean enough that the only thing it doesn't yet have is that minimum level of EBITDA, there is an add-on or tuck-in transaction to be done there. There's a strategic acquisition to be done there. Oftentimes, the easiest way as an investment banker to go find the buyers for a business, first you create a buyer universe by looking at the databases, searching for who's buying these kinds of businesses. And then oftentimes, in collaboration with the founders, say, tell me who your biggest competitors are. And there is a way to bridge that communication without tipping them off to the idea that you're the one that I might be representing, to make sure that we find out whether, in addition to their organic growth strategy, they're also looking to grow by acquisition. Most are. And it's easier for the investment banker or a business broker who's oriented that way to go find that buyer, in the same way that, like, look, it's not like Jeannie Buss and LeBron James sit down together and work out his deal year to year.
Right.
Like, there's an agent and a general manager involved in that transaction. So there's a way to make that happen, even for the businesses that are not that 2 to 10 million.
All right. So what you're saying, what I heard was, through all of that, I heard there is still hope for us. So that's always good. What would be a step that a company like mine, again, I'm going to use mine as the typical example of somebody that might be in our audience. What would be a next step for somebody like us if we are, look, I don't want to exit tomorrow. I enjoy doing what I do. I'd even love to have somebody buy it and me stay in the business for a few years to help them grow it. And if there's, I always look for the other opportunity. This is great, but if I knew that I had dollars coming in the door, I could spend my time moving on to, okay, maybe we can create a code to automate this entire process and have a lower end system for clients that don't have the bucks to pay what we charge. But I don't have the ability or time to do that right now as the founder because I'm busy running the company. So what do you say to somebody that's in my case? Yes, there's still hope. What is the next step for somebody like me?
Yeah. So the things you do to put yourself in a position to be ready when the time comes, or professionalize your financials. Look, the deal is going to be struck based on the transferable economics. So no matter how unique the business is, and, with apologies to everybody that's in the valuation world, like, IP valuation is BS. Nobody ever pays up for that. And frankly, unless you're going to sell to your employees or you and your partner have a challenge that's going to need to be negotiated or settled through attorneys, you probably don't need to get a professional valuation. It's money you don't need to spend.
Right.
Because there is a transactional professional like me out there that can tell you what your business is worth because they're doing deals all the time.
Yeah.
Right. So professionalize the financials. It's going to be a multiple of either revenue or EBITDA. The other thing is make sure that all your documents are executed, right? So a lot of businesses have one side of each contract, one side of the contract signed, but not both sides signs. Anything, that needs to get kind of taken care of if you were going to transfer the business, like there's a, ex-employee who's simmering out there and might be, get that sorted out before you go. And then, make sure that simple things like, did the state you're in send you acceptance of your S corp, right? Like, do you have that? Do you know where your cap table is, right? Do you so you've got to have all that ready. Once that's professionalized, then you say, okay, and maybe you do this through a transactional professional, or maybe you just get access to the databases yourself. What are the buyers in my sector paying up for? And what are they discounting for? So generally speaking, the simplest things are to say, okay, well, if they're paying multiples of revenue and they're paying recurring revenue, is it possible to move my business into more recurring revenue? How could I make myself look more like that? And then if they're discounting valuations based upon customer concentration, like I sell widgets and I hit all their numbers, but 80% of my business is done through Amazon or Walmart.
Right.
Okay. That's going to be significant valuation reduction there.
Change their algorithm tomorrow and we're out of business, right?
That's right. It's what we call silver bullet risk, right? One shot, business is dead, right? And so, making sure you're on that path, what we call for many of our consulting clients, a trajectory plan. And then the other thing too is, Okay, so maybe it's not reasonable for you to organically get to 2 million of EBITDA yourself, but would it be feasible for you to find other similar businesses to maybe combine your economics in some way so that the aggregate, if you guys, kind of figure out a way to work together, to kind of aggregate the businesses, could you present, those kind of economics at 2 million and above in EBITDA as a combined entity? Everybody's still running their business, but you've essentially gone private equity, pre-private equity, right? Mm-hmm. Like you haven't taken their bite, right? But you've essentially configured yourself by doing kind of that roll up or add on or tuck in strategy already. And then the other thing too is that developing a successor and becoming a limited partner in your own business so that you can go on and do some other things, looking at an ESOP, doing a seller finance transaction. There's a whole bunch of alternatives to sale to an outside buyer. It sounds really cool to get a whole bunch of cash at close and ride off into the sunset. But most transactions don't happen that way anyway. Most of the time, you're going to end up working with private equity guys you don't like at all, and you're going to quit after 12 to 18 months, if you even make it that long, right? So alternatives to an outright sale to a financial or strategic buyer should also be explored, because there might be some tax advantages to like doing an ESOP.
I love that. You just said like 18 things that I've had other M&A specialists on, I've had other advisors on, I've had plenty of attorneys on the show, and they generally are a one-trick pony. And you just gave me like 18 things that I need to think about, and those are all great things. So when Zoom, which has this new great feature called Summary AI at the tail end of the meeting, it's going to list all of the things that you just shared for our Nice Guy community. All of those will be in the show notes, and the access to, of course, to awesome. Candor Advisors will be there as well. Totally cool. Hey, I know I've promised you a short interview, but I have a couple more questions. Do you have time for a few more?
Sure. Happy to.
Excellent. One of the things that you shared in the we have this little Q&A Nice Guy community that Kirk fills out before he becomes a guest, or his team fills out before he becomes a guest. Some of the questions that, hey, what would be good softball questions for me to ask? Well, there was nothing in that category, which is fine, but there were some things that he actually shared that I thought were really cool, and I started looking on his website for more information. I'm like, oh, I've got to talk about this. You have this trademark: the buyer of your business is a full-time predator and you are their part-time prey. Totally love it. I understand it completely. Can you share what that means to our community?
Yeah, absolutely. So it is actually a trademark. I can't remember the trademark number, but that was this was an observation, like a, kind of an, oh, by the way, observation that I made when I was talking to a group. It was a Vistage, like a CEO coaching group.
Yeah.
And a guy had asked me a question about, like, why wouldn't I do this myself? Why do I need an M&A attorney? And I was thinking, probably not that charitably, about some former partners of mine when I was in the buyout world. And so I just Tourette's that out there. That just happened. And, when you say something and every head in the room is nodding, you're like, there is a visceral reaction to that. Everybody knows what they don't want to be in that equation. Right. And so like we leaned into it. I have an advisory board who then said, oh my God, you've got to trademark that. Totally. And, when we formed EBITDA University, so that for the people that were either too early or too small or not yet ready to retain Candor Advisors for any one of different reasons, we wanted to provide something to them. And so we tilted EBITDA University in the direction, one of the programs, EBITDA Stimulate, is tilted around the idea that the buyer of your business is a full-time predator and you as the seller are part-time prey. And we came up with the 6 most common predatory behaviors and the 6 best shields to those predatory behaviors.
It's incredible, because you got to think about it. You're going to do this once or twice in a lifetime as a business seller, And there's always people that are out there looking, and the sharks are out there, and they're not there. They're not there for your benefit or your edification. They're there for their profit. So make sure that you're aware of that. It's great. Hey, tell me about EBITDA University. Is that a live thing? Is that what? Tell me what that is.
Yeah. So it's completely live right now. We do one free session a month on the 6 secrets to selling your business. And then we have paid sessions for, the full-time predators and part-time prey. And that's best for, like if you've gotten an unsolicited offer, you're getting a lot of inbound traffic and you just want to make sure that you know what to say, how to kind of hit the pause button without scaring them away before you make a decision about hiring an advisor or anything like that. The EBITDA Stimulate is great for that. And then there's a 6-month course where every 2 weeks we meet and we go through one part of kind of the prepping for being involved in and executing well on an M&A strategy. And they're free, $97 and $497. So any business owner can afford to go through these things. Worst case scenario, what happens is when that, dialer for the private equity firm gets you on the phone and says, hey, Doug, we've been tracking podcast producers and guys that have your kind of, bandwidth for a while, really like your business. We'd love to talk to you about doing something together. Can you send us 3 years worth of financials and a customer list and a yada, yada, yada. And they don't even suggest an NDA. And they ask you for a bunch of proprietary information. And it's not clear at all that they have legit motives for buying your company. You will at least know how to handle that request, right? You'll know how to signal to them that, hey, look, I can balance out this equation a little bit. I can neutralize, some of that predatory encroachment.
Have you ever thought about doing here's advice. Unsolicited advice. Have you ever thought about doing like one of these live, like a weekend where you have, for $2,500 or something like that, you bring in 10 or 15 or 20 business owners, and it is a profitable weekend for you. I don't know if 25 grand is a lot or a little bit of money for you, but I keep thinking from an experience perspective, not only does it get me in the room with your wisdom and your team's wisdom, but it gets me in the room also with 9 or 10 or 20 other businesses that, you start to groupthink, you start to work towards this positive stuff when I don't think groupthink is positive, but you start to work through this positive stuff when you have all these other people in the room and you're all talking about M&A.
Yeah, well, groupthink a la Soviet Politburo, not positive.
Right.
But the idea of a cohort of business owners who can, kind of ping pong off of each other and, build kind of a knowledge community, love that idea. So we have thought about it. And if we had, kind of a big enough listserv of people that were kind of taking our stuff, then what we might do is a little bit more like a trunk show where, we do a series of cities and do invitations for it. I don't think that the economics would be fantastic for us just because at Candor Advisors, we're able to generate a whole lot of revenue in our core discipline. But I do think, and, I don't want to sound like, too preachy or, any other kind of sense of noblesse oblige here, but I do think that there is an opportunity where we can put purpose over profit and help the guys who have spent decades building great businesses that are going to get scalped by some of those private equity people. We would like to make sure that we have a conversation, whether it's in group form or individual form, with them in as large a numbers as we can.
Well, I do know that I would be on that maybe short list, maybe long list, I don't know, of business owners that would be. I was approached by somebody that I didn't know, didn't trust them, and so that was the first thing that was my red flag. I'm like, well, I don't know this person. Why is he reaching out to me? But they wanted me to come to an Arizona weekend to meet with 9 or 10 or 15 or 20 other business owners that were all in the space of, hey, how do you scale your business? And I thought, here's an opportunity for somebody to try to sell me into a mastermind for 50 or 100 grand or whatever it was. I would rather pay and be on the side of, I'm okay with paying. I just want knowledge and relationships, because that really is what business is all about. It's the connections. And I don't get a lot of connections sitting in this 10 by 12 room here doing podcasting, other than the wonderful relationships I'm able to build with guests. But I think that other people that are in my position oftentimes would like that environment. But just food for thought. Just food for thought.
Appreciate it, Doug. Stay tuned.
That's right. That's right.
I'm absorbing it.
All right, good. All right, that's good. Any questions that I am not asking you that are important things for you to share with our community? Of course, I wanted you to tell people how to get in touch with you and Candor, of course. But anything I should be asking you that I'm not asking you about the space that you're in?
Yeah, sure. Because one of the questions that I had early on when I joined the buyout firm and then comes up a lot, but I think people are afraid to ask it because they don't want to admit that they are one of a lot of people that don't know it. And that is, what the heck is EBITDA? And why is that a metric that people use for buyouts? So first of all, it's an acronym for earnings before interest, taxes, depreciation, amortization, which is another way of saying the way to figure out the transferable economics of your business are to take your net income and add back any interest on loans, any taxes you pay, any depreciation, amortization of equipment that you've bought, right? And the question that people often ask once they understand that is, well, how is that the transferable economics of my business? Because anybody who buys me is either going to assume those loans or take on that equipment or have to pay those taxes. And, the answer in brief is this. Most deals are done what's called cash-free, debt-free. So you get to keep the cash in your business, but you have to pay off the debts. That's why interest is not part of the calculation, because you've paid off the debts when things transfer. So they're not taking on your loans.
Nice.
The next thing is that they're going to have probably a different tax structure than you do. So it's not that they won't pay taxes, but if you're an S Corp and they're a C Corp, then they need the pre-tax number to put into their model so they can figure out what their taxes are. They don't care what your taxes are. So that's why you add those back. And then the depreciation and amortization, they have a new basis, because whether they do a stock purchase where they get all of your assets, liabilities, and the common stock of your business, or they do an asset purchase where they acquire each of the individual assets and exclude some of the liabilities they don't want to take on. Either way, they have a new basis in the assets, the property, plant, and equipment. And so the depreciation and amortization no longer apply because they've got a whole new schedule. That's why people use EBITDA. So I understand that Charlie Munger calls it bullshit earnings, and I don't disagree with him. I would just say that's why buyout people use that term.
Yeah, it's interesting. I thought about all those things that you were going through. we're bootstrapped. We have been for 7 years, and I have never owed a cent on any of the businesses that I've ever owned. So no interest, no. Of course everybody has taxes. S corporation, no depreciation, no capital, no. It's like I'm as liquid as you possibly could be, and it's all cash flow. And the only our biggest expense is our team. That's our labor, and that would transfer with the company as well, of course.
Yeah. I would add one more thing, Doug, because that's exactly right. Your net income and your EBITDA are really close, but also depending on your form, you're going to add back certain owner economics and one-time charges. Like, let's say you paid $25,000 last year to settle up with a disgruntled former employee. That's not recurring. So that expense comes back in when we're adjusting your EBITDA. And let's say that, you pay yourself $500,000 a year salary, but it would only cost $200,000 a year to hire a CEO. Well, that $300,000 comes back in as an add back. So, adjusting the business so that the transferable economics look like only the things that will transfer when the owner's no longer around. That's a critical part too. So it's not purely net income and add those things back. Owner economics need to come back in too.
Man, wealth of knowledge, the 30 plus years of experience, 10,000 plus hours of your skill set. Totally cool having you on the show today, Kirk. Thank you for not only supporting the show by being here, but by sharing your inspiration and your message. Great time today. Sorry to keep you longer, but I just had too many third grade questions I needed to find out the answers to.
It was a pleasure, Doug. Thanks so much for having me.
For all of those in our community, you can get more information about Kirk and what he does. Just head over to candor-advisors.com. We'll put a link in the show notes. You also have access to his LinkedIn account as well. We'll make sure that you have a link in the show notes for that. He does a lot of 4 and 5 minute, just, hey, here's a wealth of information, a nugget of information that you could get. And I know at some point in the future, there will be I don't know what we're going to call it, but there is going to be a podcast. It's going to be Kirk's podcast. It's going to be it, because he's just way too photographic not to have a podcast. Kirk, thanks for sharing. Thanks for being here on the show today. Nice Guy community, never underestimate the power of nice or the power of understanding exactly what EBITDA is. Special thanks to Kirk Michie. All of his information will be right there in the show notes. Steve O'Brien, go ahead and take us out of here.
Are you sure the legal department cleared this? Okay then. For the Nice Guys on Business, I'm Steve O'Brien. Hey, if these bozos want to get sued, that's their business. Leave me out of it. Wait, we have a legal department?